Have you ever wondered how families create generational wealth and how they use life insurance? Does it go just on one family member? Does it go on all family members? How do they use the cash value? Who's the death benefit paid to? How does it actually work? Today, we're going to talk about how families use life insurance to create a legacy from one generation to the next, and how they will typically use a trust to control the life insurance policies. So where it typically starts is with a family. Typically it's one family member. This is just my experience. It's usually Papa who would like to set up something for the entire family. Now, he'd like to set up a trust in order to control the business that the family owns, could be real estate or just other opportunities. Now, they either have to have money or they know money is coming in. And here is a big reason why the trust is set up: for responsibility. You don't have to have a trust to create generational wealth. For example, you might have a family of 5. You might be worth $5 million. And when you, mom and dad, die, that $5 million is going to be left to your kids. If you raise your kids to be very responsible and you say, I want you to continue to run the family business, or I want you to use this money just for real estate, I want you to do X, Y, and Z, and they follow your direction, they'll continue to increase the family net worth. And then they can do the same as they raise their children's responsibility. The problem that pops in is responsibility does not always occur. So a trust is set up in order to make sure the family continues to be responsible, and specifically beyond just one generation. Now, here's the thing: whenever we're using a trust, everything I'm going to talk about today can usually be done with cash. A lot of families do it this way, just as they grow their net worth and they've got cash in the bank, they use that cash for other investment opportunities. But using a life insurance policy can be a much better tool than cash if it's used correctly and if it's set up correctly. And I'll talk about what that means. So typically what we see is a situation like this. Here is a family of mom and dad, kids, and also grandkids. We've got Joe Sr., he's 68. We've got his wife, Kate, she's 65. 3 kids between the ages of 38 and 45. And then you also have the grandkids down here as well. Now, what I want to say is having policies on each family member, it is common, but it's not necessary. Sometimes I'll speak with individuals who feel that they have to start policies on the entire family at once. Maybe they want to do that, but it's not efficient. Usually, if you're going to start something new, would you recommend doing everything at once or testing out maybe just with 1 or 2 people to start? Testing it out first, especially if you've got to get everyone else to buy in. Now, with that said, why a trust is typically used in this situation is a trust is set up to own the life insurance policies on each family member, and the trust is also controlling those policies. Now, what controls these laws specifically, or controls the trust specifically, is what is called the trust laws. We've got who, what, when, and then approval. Who, what does that mean? Well, who could entail the family members that are part of the trust. The trust is going to own life insurance policies on each of these family members. Who could also involve outside counsel, who is going to help the family make informed and educated decisions whenever they are looking to use some of their money for business, for real estate opportunities, whatever it might be. So the who is very important, just like it would be in a business. Very similar when you look at these trust setups for families compared to how businesses are run. What? Well, what could be investing in a business, a family member purchasing a new home, or looking at investment opportunities, and it can go well beyond that. But you will have specific details often in the trust laws that specify who, maybe it's Joe Jr., can use the money and for what he can use the money for. Now, sometimes you'll see provisions in here as far as when they can access the money. You might see this for the grandkids, where the goal is perhaps to have them invest in the business, invest in real estate, whatever, but we don't want them to do that until they are old enough to be responsible. Whether it's 18, 25, maybe it's not an age, but it's when all of the family members agree, yes, we feel this person is responsible and educated enough now. And then we've got approval down here. So I like this one a lot. The approval could be the board. A lot of times you'll hear of the family office concept here, but the board could involve everyone meeting and needing to agree on any decisions that are made. And everyone doesn't mean the entire family, it means everyone on the board. So for example, if Joe Sr. and Kate felt very, very strongly about ensuring the family's long-term legacy was secure, they might set themselves up as board members, meaning they're going to help authorize any decisions or approve any decisions. And then they also involve the oldest, Joe Jr., because he's really into this and he wants to be a part of it. And then they also have outside counsel, which could be an attorney, their CPA firm, and other advisors that they trust, that they want an outside perspective to come into the family so that they don't make biased decisions or anything like that. It's not uncommon to see that. For example, with my trust, I do have 2 attorneys that don't really know too many of my friends or family members, and I did that on purpose because I wanted someone completely separate, especially if anything happened to me. This way, I've expressed how I want things handled, specifically for my wife, and they know this, and it's all in writing, so this way they can make sure that the same decisions that I would have made while I were alive are still being made for my wife and also for my company and all the employees here if anything did happen to me. So approval needs to be made by the people who are specified in the trust laws in writing that are authorized to grant this approval. And sometimes you'll see that it can't just be one person. Multiple people need to sign off on approval. So if Liz wants to buy a car, well, 3 board members might need to approve it. She just wants to buy it to have fun, they might say no. If she wants to buy a truck for a lumber company that she wants to start, okay, that might be approved. See what I'm saying? There's more than just a yes or no, sounds good, that goes into it. So what happens here with these strategies, you can see the responsibility part, right? The trust controls everything. With the life insurance policies, the trust is the one funding these policies. The trust is the one that ultimately has access to the cash value, whether the trust is taking policy loans or if the trust is dispersing income. Because when you look at supplemental income coming from life insurance policies, a lot of people use these products to take that income tax-free. If you do everything right, you can do that easily. And then also, the trust receives the life insurance payout, 100% income tax-free, when each family member eventually passes. So, through a trust, what families will typically do is use the cash value, like their family bank, if you want to call it that. What's really cool about this is once they build that cash value up to be a large enough dollar figure, if they want to make a large investment, maybe it's purchasing an apartment complex, if they've got the capital to do so in their life insurance policies, then they don't need to go to a bank or third-party financing. They've got the money in their policy, and it's way easier to take loans from a life insurance policy than it is from a bank. So that's how they use the money while they are alive, and then the life insurance death benefit, well, that results in more generational wealth. Because the life insurance proceeds will always be larger than the cash value, and when I die, the life insurance benefit is paid out income tax-free. That's why people like it. Let's take a look at an example of how this works. So, Joe Sr. and Kate may have started this plan, and they may be the ones that have ultimately funded this trust. They seeded it with money, and maybe they continue to do so. But the trust is going to have the money to start. Okay. Now, trust has the money. Let's say Joe Jr., who has a whole life insurance policy that the trust owns on him, wants a piece of property. The purchase price is $1 million, And he wants this property because he is an investment analyst and he sees that he can generate a 10% return annually. So to purchase this $1 million property, he is going to go to the trust to get this money. So the trust must approve that $1 million purchase of the property that he wants. Assuming they approve it, how it's going to work is the trust is going to authorize a loan coming from the whole life insurance policy. Here's the key on this, why people use life insurance. The money that's borrowed, call it $1 million in this example, keeps compounding. So I might see my cash value grow somewhere between 4 to 5% per year if the product is set up right, and I continue to get that 4 to 5% per year. Also, it's growing tax deferred and I can access it tax-free, provided I follow IRS rules, but that keeps on compounding while I've borrowed it from my life insurance policy. Now there is a cost to borrow here. There's loan interest that goes to the insurance company. That's something we typically analyze for clients to make sure that the compounding they're earning on the policy is exceeding the loan interest that they're paying. But what's happening is it's still under the umbrella of the trust, but now Joe is operating under that trust in a responsible manner to acquire this property. The money does not come outside of the trust and go to Joe. I've seen some families do that. Some have talked about it, but usually from a tax benefit standpoint, what happens is everything stays under the trust's name, meaning the trust is the one ultimately purchasing that property. Joe is just the one making the decisions here, if that makes sense. Okay, so that property producing a 10% return would be $100,000 per year. Now a question that comes up sometimes, and if they don't ask it, I'll ask it for them, is what if the deal falls apart? Here's how you prevent the policy from falling apart if the deal falls apart. The maximum loan that we might want to take might be somewhere between 70 and 80%. You could take more than that. We're just leaving a lot of juice in the orange in the event everything falls apart and I can't pay the loan interest, I can't pay the premium, I can't pay anything. What I don't want is a situation where the loan interest exceeds the interest earned, my cash value starts to go down, my death benefit goes further down, and eventually the policy can lapse. It's rare with whole life. Where it can happen is if I take maximum loans, call it 95%, and then I can't pay anything, the premium or loan interest, that's where it can lapse. So there might be a provision in the trust that the maximum loan is 70 to 80%, or a greater loan can be taken, but it must be approved by the board because there is proof or confidence that that loan interest at the very minimum can easily be paid from the investment that's being purchased or other sources. Like that's the big thing that we just want to run the numbers and make sure it works okay. So that $100,000 per year is going to be used, partially or fully, to repay the policy loan. Notice, the trust is doing this. All the meanwhile, while the loan is being repaid, the trust owns the life insurance policy. The cash value is still compounding, the money that's outstanding in loans and the money that's not outstanding in loans. That's all still compounding. The death benefit is still appreciating. And then the trust owns the property, which continues to produce income and also appreciates over time. The fair market value goes up. So this is still compounding while this is still earning interest. And they use the dollar that originally went into this whole life insurance policy. See what's going on here? So they'll continue to repeat that process. Joe Jr. will, and maybe it's other family members as well, as they gain an understanding of this and act responsibly. But while they repeat this, their money in the life insurance policy keeps on compounding. So they're increasing the family net worth, not really through the cash value growth. 4 to 5% per year without risk is great, but that's not really what's going to grow someone's net worth. Over a long duration, you'll see it compound nicely, but getting that 4 to 5%, while at the same time, I acquire real estate or invest in other business opportunities, whatever it might be, where I hit my home runs, that's really what's going to propel the net worth. It's usually what I've seen over the years where families do really well. So As the net worth continues to increase, Joe keeps on doing his thing, but eventually he kicks the bucket. When Joe Jr. dies, the death benefit is paid out 100% income tax free. And this could be worth in the tens of millions or hundreds of millions of dollars. It's all relative to the size of the policy and when we pass, but that is paid income tax free. I'll clarify that it is not paid out estate tax free. Death benefit proceeds are not exempt from estate taxes, which is why you'll see many attorneys set up a trust. It's often referred to as an irrevocable life insurance trust or a different type. Sometimes it's a spousal lifetime access trust, but it's a trust that is owned outside of the individual's estate in order to help with those estate taxes. Of course, you want to have a professional or an attorney set that up properly and provide the education. I only know a little bit from my experience and working with other professionals there. But that's paid income tax free to who? The trust. The trust then receives this large windfall, and they use that windfall to pay any debts, for new opportunities, and starting new policies, maybe on the grandkids and their kids and future generations. So they make that a point to continue this cycle by taking out new policies because the money keeps on compounding, it's easy to access, and they receive the large windfalls income tax-free. Before I move on to the next section, the one thing I want to mention here is small businesses, large corporations, and banks do the exact same thing. I'll clarify. Banks do it a little bit differently. They're not accessing their cash value, but the death benefit proceeds are used in the same way. Small businesses and corporations do the exact same thing. It's really cool when you see how they use employees instead of family members, and then the company owns the cash value. They use it for business opportunities. It's just a company umbrella instead of a family trust umbrella, if that makes sense. All right, to wrap this up, here's the most important thing. Make sure the policies are set up right, because in most situations, what I see is policies are set up with high upfront commissions, and if a policy is set up incorrectly, the mistake can sometimes be very difficult to correct, can lose a ton of money, and sometimes you can't correct it, or you just have to eat the loss. And something I see sometimes that I don't really like is high net worth folks may trust whoever their closest team members are, and if they're told this is good, you should do it, they do it, and sometimes they don't even look at the numbers. Like they don't look at where their money is going. And then they find out after the fact, they were sold a really, really bad deal where they could lose millions. We just saw a case like this. Here's an example. It's for a young guy who was funding a policy with more than $7 million per year. It's close to $8 million annually. So here's an illustration of what he was sold. He actually paid in a little bit more than this per year. $7.6 million annually. Look at your cash value in the first year. $2.8 million in change. So if this is you, it means you paid $7.6 million, you have $2.8. If you don't like it and cash out, you lose the difference. You walk away with $2.8. You lose almost $5 million in that particular case. What happened to him is about a year and a half in, he started looking at the policy. I don't know how he didn't look at it earlier, but it's neither here, it's irrelevant now. He's looking at it and saying, okay, like I'm having second thoughts. This is a huge premium I'm committed to. I'm making very, very good money right now, but I don't know if it's going to continue forever, and I don't really like being on the hook for this $7.6 million premium payment. Is there anything that can be done? With this particular policy, with this particular company, the answer is not really. There's a few things that can be done, and we did show some solutions here, but they're not good. Like when you look at this guy, it takes around 8 years or so just to break even. And any solutions where he lowers his out-of-pocket delays that break even more. The break even is when your cash value equals your total payments. if you multiply 7.6 million times 8 years. So I'll show you here quick. Here's what he was sold. So we had this up. Here it is on Excel. And then I'll show you what could have been done. So this is what we just looked at. Funding a total of $7.6 million. All of the money went toward what is called the base premium. This is where most people start. This policy was recommended, by the way, by an attorney as far as, hey, you should get life insurance for estate planning, and he was sold something like this. This PUA, which stands for paid up additions rider, is 0. That's the problem right there. Most people don't even know what that means, paid up additions rider. If you don't know what it means, cash dump in. Another thing to be aware of is the base premium pays the highest commission, the PUA pays the lowest commission to an agent. So you can see that incentive here. 7.6 in the first year, 2.8 in the first year cash value. It is finally by year 8, where he's paid a total of $60,800,000, and he has $61 million in change. Check this out. This is the exact same product with the exact same company, just designed for cash value. His out-of-pocket is the same $7.6 million. What is the difference here? Instead of socking it all to premium, we have our premium at 10% and our PUA rider at 90%. It's probably closer to 88%. We've got term insurance and such added here. But the first year, what do you notice? 7.6 million is paid. He's got 6.9 million instead of 2.8 million. The life insurance benefit is a little bit less. You could make it the same. It might drop your cash value to 6.87 million or something like that. It's not much of a difference. The break-even point is between years 3 and 4, meaning when his cash value is equal to or greater than his total payments. So much faster growth out of the gates. In fact, you can see it right here. Check this out. There's your cash value difference. This is showing how much more or less you have in cash value with this policy compared to the one on the left. $4.1 million in the first year. As time passes, that gap just widens too. Like these aren't small numbers. These are millions of dollars in cash value and death benefit just by having the knowledge to know what a policy should look like when you start it. The start is so, so important. Now for him, the life happens scenario is big because him having second guesses now, how do I exit this or not lose money? The way he's set up, he can't do much. If it's set up with that low base premium, you do something like this, where he just stops after the second year, pays nothing toward the premium or PUA riders. Out of pocket is 0. Cash value still breaks even between years 3 and 4. It's because he max funded it for 2 years. That's always important here. But continues to appreciate. We reduce the death benefit, but it's still a healthy amount. What does it look like if he wants to reduce it? So a lot of times, what I've run into is this idea or thought process that high net worth families or people with money don't need the cash value up front because they have a ton of money. It's like, that's nonsense. Most of them that I've run into did not have a ton of money to start. Like they built that from 0. So why on earth would you take that money from them? It's like, no. If you can maximize their value up front and still have it long term, why would you not do that? Because if it's me, that's what I want, so I could use my money for business opportunities and such. Like you don't just put it all away in order to earn a high commission. It doesn't make sense to me. So the big takeaway here is an attorney or an advisor's involvement doesn't mean that the plan is always going to be good. Now, most attorneys are not insurance experts. They're really looking at it from a holistic approach. So some of them do have some knowledge, so it's always good to involve your attorney. But really, the key is here, making sure you've got an insurance expert. And if you don't want to work with an agent or someone that is licensed and is incentivized to sell the policy, like that is how our company makes money, by selling these policies. We minimize commissions, but still, that's how we're incentivized. What you could look for is a fee-only advisor. Specifically, I'd look for a fee-only actuary. A good one is Scott Witt. I've worked with him before. We've got podcasts on our channel. I do like him a lot because he is just to the point, numbers guy, data-driven guy, likes to look at the historical performance and the updated illustrations from companies, and he also understands life insurance inside out. He's an actuary. So he charges a fee to review any proposals, and he'll work with your current advisor. He only will introduce us if someone's not working with an advisor or if they want an introduction, but he's big on maintaining that relationship with whoever you're working with. But that is a nice way to work with someone who's not incentivized to sell you a policy. All right, back to this. Creating a lasting legacy and using life insurance inside of a trust. Recap to the strategy. I've got my trust. Step one is then starting a whole life insurance policy. Then, using the cash value responsibly. What does that mean? It means you've got the trust laws in place that are going to ensure access to that capital in the policy is used in a responsible manner, meaning people have to approve the use of any money that you want to take from your policy or from the trust. And then long term, the life insurance payout, which is the money that's paid out when I die, if I have a life insurance policy, is used to continue to grow the family net worth and used to pay off debts for other opportunities, whatever it might be, because it is a large income tax-free windfall. Hope you enjoyed this video. If you did, please let me know. You can hit the like button. Let me know in the comments below. If you have any questions, feel free to leave them in the comments below. You can also DM me, preferably on LinkedIn, or you could come across our website, ibcglobalinc.com, and on our Contact Us page, let us know you watched the video and let me know if you have any questions. Thank you so much for watching all the way through, and as always, I hope this helps.